the business I built got bought, and it was really badly handled. I mean, catastrophically badly handled by the people who bought it. And I ended up leaving. And so when I came into this business, a lot of how badly it had gone informed how I felt an acquirer needed to behave. So a lot of the things we're going to talk about today, a lot of the decisions we made about how you handle integration, how you handle cultures coming together, how you handle different types of people, was informed by how badly I had felt I had been treated by the business that bought my business.
This podcast is brought to you by Scoro. When we talk about automation, most people think about tools like Zapier or Make, small actions triggering other small actions. But to unlock real efficiency, you need to get deeper than that. That's what Scoro, a professional services automation platform, is designed for. That means deep automation benefits like having a document sign-off workflow that pings the sales manager for approval when someone finishes building a quote. Being able to turn quotes with planned line items into projects with tasks at a click of a button. Being able to create invoices based on the project. Being able to see your capacity to take on more work based on bookings in the system, and loads more. All of that without needing to copy or export. You can even plug in other tools like your accounting platform, HR system, and yes, even Zapier, so the data flows even wider. If you're serious about scaling, you'll hit a point where you need a PSA, and in my view, Scoro is best in class. Go to scoro.com/demo to book a call and find out how Scoro can help you in your next chapter. And for the VIP treatment, tell them Harv sent you. Now, let's get to the podcast. Hi all, welcome back to The Handbook, the Operations Podcast. I'm Harv Nagra. If you caught my last interview with Sam Wood, we talked about why you should run your business like you're planning to sell, what that actually means, and how to get there by building board-level accountability. That episode wasn't just for founders with an exit in mind. It was about building a business that runs well regardless of your plans. And today's episode takes that conversation a step further. In fact, I've had quite a few requests over the months for something that breaks down the M&A process, mergers and acquisitions. Not sure if that means more businesses are exploring consolidation or if it's just a topic that's always had a bit of mystery attached to it. Personally, I've never been through a sale, acquisition, or merger myself, so I've got some questions too. How does the process actually work? What makes a business worth acquiring? And change is hard in one business. How do you avoid creating operational chaos and keep morale up when you suddenly go from owning and running one business to 5 or 10? So in this episode of The Handbook, we're going to go behind the curtain of an agency group that's built entirely through M&A. Our guest today is Dom Hawes, Group CEO of Selbey Anderson, a marketing services group he launched with private equity backing and a very clear M&A game plan. In just 30 months, Dom led the acquisition of 11 agencies, growing the business from 0 to £22 million in revenue with a team of over 200 people. He's been very hands-on with every part of that journey, from the search to negotiation to building the group's culture and integration strategy. And today, he's pulling back the curtain on what it really takes to scale through acquisition. So whether you're trying to get your agency, consultancy, or professional services business in shape for a future sale, or just want to understand what strong, stable foundations look like from someone that's acquired other businesses, this one's for you. And a quick request before we hear from Dom. If you know someone interested in a sale, merger, or acquisition, please take a moment to share this episode with them so they can learn along with us. I'll let you do that now. All right, well, let's talk to Dom. Dom, welcome to the podcast. Thank you so much for being here. I think, why I wanted to go into this topic, a lot of us are aware of what M&A means, but unless you've gone through the process, you don't really know what it really entails, what you should be aware of before and perhaps after. And I found it quite interesting. You set up Selbey Anderson with a buy and build approach from day one, which is quite interesting to me, that there wasn't kind of an organic approach where you decided to acquire another business, but you started off your business with the intention of acquisition. So can you tell us a bit about that? Why acquisition and not grow and build from scratch?
Yeah, sure. Partly for those who are watching on video, it's age. But also, look, I had been an agency at the beginning of my career. I spent 6 years in agency there, and then for a year I ran my own. And I ended up pivoting that into a product company rather than a services company. But I always liked the marketing services space. I like creative people. I like strategists. I like the kind of people that hang out in agencies, and I like the work. I mean, the work's really challenging. So I always saw it kind of as a bit of a spiritual home. But when I looked at who I was, by the time I ended up coming back to agency, and I spent 17 years out of agency, I'm not an agency person. So my time in between had been spent consulting and doing corporate finance work. So I came at this, I guess, from more of a corporate finance angle than I did from an agency angle. So although marketing is the golden thread through my career, I'm not an agency person. And any of the agency people in our group will tell you that. So when I came back to it, it's very much looking at how do we build scale super fast. It was a different age then, obviously. 2017, 2018, when we were putting the business plan together, is worlds apart from where we are in 2025. But the decision to go buy and build was about speed, really, speed to get to scale. And realistically, if you want to start an agency from scratch, then try and turn it into a platform to seek investment. That's unless you're very lucky. The outliers can do it in 2 or 3 years, but for the majority of people, it's 5 years. And I wanted to get ahead faster than that.
Mm, really, really interesting. Can we actually jump back a little bit before? Because you were saying that you were kind of new to agency, but you'd kind of, the golden thread was marketing. So where did the inspiration come for you that this is what you wanted to get into?
Well, so I started my career actually in the military. I did 6
Okay.
years in the military. And then I left there. It took me a year and a half to get into an agency, and I had to start in the post room. But I worked my way out from there, and I spent a total of 6 years then in agency, and I really enjoyed the work and I loved it. I left really because it was the time of the dot-com boom. So
Okay.
it's about the millennium, just before the millennium. And I joined a startup, and then I did a bit of venture capital work. So I kind of morphed out of agency life anyway. So then in 2001, I set up an agency again, focused on early stage startups. But within a year, I wanted to run a product company, not a service company. But that was enough. But I understood the concept. So then I set up a product company, and I did all the 4 Ps there: product, price, and place and promotion. We had to do all of those things. We ran an import-export business. So I was doing marketing all that time. But when I looked at, so I knew I wanted to do a buy and build. That's the starting point. I knew that we were going to buy and build something. And I looked at all sorts of different categories. And when I looked at marketing services, then there was a certain part of the market that was very underserved. So if you were a big agency, the networks were snapping you up. If you're a really small agency, you're too small to sell. But there was that trap bit in the middle where you're doing, at that stage, it was kind of between about 500,000 and 1.5 million in EBITDA, where you'd struggle to find someone to buy you. And at the same time, the demographic of agency owners, they're getting older and they need somewhere to go. So they're either going to close it down and a load of people are going to lose their jobs, or they've got to find someone to buy it. And I'd been through a sale in 2012. That was the last year I was in the business I built got bought, and it was really badly handled. I mean, catastrophically badly handled by the people who bought it. And I ended up leaving. And so when I came into this business, a lot of how badly it had gone informed how I felt an acquirer needed to behave. So a lot of the things we're going to talk about today, a lot of the decisions we made about how you handle integration, how you handle cultures coming together, how you handle different types of people, was informed by how badly I had felt I had been treated by the business that bought my business.
Really, really interesting. Rather than picking at what was badly handled, let's say some that organically gets
Yeah.
answered as we go through some of this process, but I will revisit that towards the end if we don't cover it and see if there was anything else that you didn't get a chance to talk about. So I guess I'll start by asking what makes an agency attractive to you as a buyer? Is there a profile that you're looking for? You're talking about this kind of middle kind of Goldilocks
Yeah.
zone in terms of size, specialism, financials, or leadership? What is it that you look for?
Well, we're in a very different world now than we were then when I was doing it. We bought a lot of agencies quite quickly, but there was a particular economic climate there. We're in a very different world now. And I was building to a vision that has changed since then. We've had to change how we think about the future based on the way the world is, because it is very different now than it was in 2017, 2018. So we set out to build scale, scope, and reach. And so scale, i.e. numbers of people, scope, i.e. we wanted to cover the full range of promotional activity, and reach being geography. So, but we were always focused on a certain number of vertical markets, predominantly business marketing, predominantly in complex, intermediated, or very heavily legislated businesses. So we like the messy stuff. But given those economic circumstances we had then, what I really needed, what I looked for mostly was leadership. So I
Okay.
was interested in acquiring agencies that had a strong team who could help me build the group. That was my number one. I mean, like everyone, I think if you set out to buy, you've got to work out what's important to you and what's going to help you fulfill your strategy. And I think also the more you do, the better you get at them. And particularly if you're acquiring a lot or many companies in a shorter space of time, people know that you're on the acquisition hunt. So opportunities start presenting themselves to you too. I mean, there are some table stakes. Actually, I should say there are some table stakes, right? So number one is the agency's got to be profitable. It has to
Mm-hmm.
be profitable. We're not in the turnaround business. And we were trying to move at speed. So we wanted profitable businesses. Our investment profile we may touch on this later, but our investment profile looked for long established, stable businesses. So although we managed to raise a significant amount of money to start, it wasn't a bottomless pit. So our appetite for risk was reasonably low. So we were looking for long established businesses that were profitable, good client tenure, good people tenure, agencies that we knew we could buy and that would continue trading at or at similar levels as they were trading beforehand. And then we would try and apply some of our secret sauce to help them grow, strip out a bit of cost, improve profitability. That was kind of our thesis. So, but the table stakes are profitable, good client list, and the other hygiene factors. There are actually Moore Kingston Smith published a list of 10 value drivers in agencies, and we pretty much looked at 5 or 6 of those straight off the bat. So quality of revenue, it's got to be a
Mm-hmm.
good quality client, it's got to be a good quality contract, it's got to be
Mm-hmm.
profitable, it's got to be in the right sector. Like the agency has to have a focus, a clear speciality. So we were in the business of specialism. So there's a bunch of stuff that was like hygiene factors, if you like, but the deciding factor was often the leadership.
Right. And tell us a bit about that. What does good leadership look like, or what were you looking for exactly?
Well, I think a clear understanding of strategy, what it is, but also what it isn't. And so good leaders often present themselves and their agencies very well. They position well.
Mm-hmm.
They understand what that means. They have an inbuilt ability to get the operational side of things. They get it. They understand it. I like my leaders to be polymaths as much as possible. They need to be good at a lot of different things. I think where you have people who have come up very strongly through one discipline and have ended up in general management but don't have general experience, I think it can be difficult. So, as a good leader of an agency, you need to understand finance and obviously marketing, but marketing for yourself as well as for your clients. It's not the same thing. You need to have the honesty, I think, intellectual honesty, to be able to apply the same things you say to your clients to your own business. You need to understand systems because a good agency will almost invariably run on a good system. And part of that is human systems, and part of that is the technology systems that underpin them. I think you need to have really strong principles and ethics, which speaks to culture. So being a leader is not an easy thing to do. It's a very difficult job to do. So we bought 11 in the end. I think I must have met 250 agencies,
Wow.
probably over the period of that sort of 2.5, 3 years. And not all of them had issues or problems. Some of them were too big, some were too small or whatever. But quite often you'd meet an agency where you had a really good team, but there was just something about the leadership that I just didn't like. We didn't We didn't gel, we didn't click.
Hmm. Really interesting there. There's a couple of things that I just wanted to highlight. Something you said about having a clear understanding of what strategy is and isn't, which I just wanted to point out because of the episode that's going to go live right before
Okay,
this
okay,
one. That's where our guest spoke about that
okay,
exactly as well,
okay.
that you need good governance. And part of that is having a clear idea of what you are in the business for and what you're not. So I love that. The other thing about good leadership, there's this kind of common thing that someone started a business because they are good at what they do, perhaps, and they've become an accidental founder.
Yeah.
And what you're saying here is you need to have moved past that and have a really strong understanding of operations and even good systems and stuff like that. And those are all things that we talk about here on the podcast quite often. So I'm just going to ask about that in a little bit more detail. Is maturity of operations something that you would
Yeah,
assess?
definitely. So what I mean, look, this isn't my learned wisdom that was received. I learned it from other people, and it's reasonably well known that there are ceilings as you grow an agency or any people-based businesses. There are ceilings that you hit as you go along the way. So the numbers may be different now, but when I was looking around the 1.2 million pounds in revenue number, that's the maximum one person can manage as a founder leader without getting really good systems in place and then delegating and having someone else run them. And the job of a leader is to build a system and then hire someone else to run it. It's not for them to run it. That's not the job of a leader.
Right.
The leader should then be building the next engine that someone else can go run. That's how you get growth. And then, so if you've got two founders, that number's about 2.3, 2.4 million, something like that. So if you don't have really good systems in place, you just can't grow beyond that. Something keeps falling over, whether it be client loss or your profitability starts eroding or you start hemorrhaging people. There'll be something, there'll be a symptom, the cause of which is operationally you're not strong. Now,
Mm-hmm.
when you're doing what we did on M&A, where we believed one of the things we could bring was some operational rigor,
Mm-hmm.
that wasn't necessarily a red flag for us. That could almost be seen as hidden value, like great agencies, super bright talent, operationally not necessarily super strong. That's something we can fix. I think it's easier to fix some of the operational issues than it is attitudinal or culture issues.
We've been talking about some of the things that make an agency or a business attractive to you as a buyer. Let's talk about kind of some of the red flags. And you were
Yeah,
alluding to it there in your last answer. But what are some red flags that would make you immediately say, "Okay, we're not going to pursue this,"
there are
even
loads.
if
There are loads.
even if the client list or numbers look good?
Yeah,
So let's
so
get
there's
into it.
loads. I think the number one is if you don't have a meeting of minds. If you meet the vendor and you can't like or trust or want to work with them, you have to want to work with people. It depends on your
Mm-hmm.
model. So we had different acquisition models depending on the stage of life founders were at. And when we very first started, we did a few kind of retirement sales. Actually, I much prefer younger founder-led sales where they want to come and be part of a bigger platform, because that's where we get our next generation of leadership from. So you're going to have to want to work with them. And, that integration piece, working with agencies post-acquisition is really hard. So you need to make sure that the people are people you absolutely want to be hanging out with. So that's number one. Number
Mm-hmm.
two is during the process of acquisition, it's very easy for agencies to lose focus and focus on the transaction, not on their business. And so the
Okay.
numbers start tanking mid-transaction. That's
Mm-hmm.
a massive red flag. And a number have fell over for that reason, like the thing stops performing. On the same level, really important is total transparency and things like if someone listening is selling their agency, when someone asks you for numbers, get them to them really quickly, because that
Mm-hmm.
just shows someone like me who's buying that you've got your shit together. If it takes
Yeah.
you 3 weeks to get numbers together, I know it's going to be horrible working with you. So there are some behavioral things like that. One of the other big red flags I was thinking about this morning as I was on the way in, which didn't seem to at the time, but if an entrepreneur says to me, I'm looking to de-risk or I'm looking to take something off the table,
Mm-hmm.
for me, that's a challenge because I don't want necessarily to be the one they de-risk into. De-risking implies that they've had their best years, they're a
Mm-hmm.
bit worried about the future, so they've got to take some money off the table before things start going wrong. So
Right.
I'd be very cautious if you're selling, giving a reason that you want to de-risk. I'd be very
Mm,
cautious. So someone like me who's buying, you want to buy a growth story. You want to buy an agency and believe that you can help them get 12, 15, 20% growth year on year by
hmm
applying good systems, putting systemized sales in place, tweaking
mm,
margin, looking at all the things that you can do to improve a business. So, I mean, most of the red flags actually are people based, actually. It's
right.
things that come out in conversation while you're talking to people. And they inevitably come down to can I or can't I trust this person?
Yeah. So let's get into that process a little
Yeah.
bit more, Dom, for the benefit, well, of myself and any listeners who have never been really close to an M&A deal. What does that process actually look like? So I guess you kick off with some conversations all the way through to the kind of signed deal. Can you just walk
Yeah.
us through some of that?
So actually, we need to step one level, I think, before
Sure.
that first. So there are different ways, obviously, of deals coming about in the first place, or potential deals are coming about in the first place. So some people will go and speak to a broker or advisory company, and there are specialists and there are non-specialists. They'll give you an idea of the value of your agency and they'll help you set up, they'll talk you through the process. So the first thing is understanding how you end up in a process. So for some people, it's deliberate. They go at a point and they're going to work with somebody. For others, they get approached. So they'll get a letter through the post or an email or a phone call from a broker saying, I represent X and they're interested in buying you. So that's kind of a different thing. If you're going to market deliberately yourself, the first thing you need to do is put together an investment memoranda, a
Okay.
document explaining who your business is, what your numbers look like, and a teaser document, which is an anonymized 2 or 3 page document that basically is going to be sent out far and wide by your agent. So if you're being approached, you won't need an IM, but if you're going to market yourself, we'll need an investment memoranda. Then the first thing, so the way I used to run it, and I can't talk to how anyone else does it, but I have been on both sides of the table. The first thing is a chemistry meeting. So you get together to say, hey, do we like each other? Do our businesses have anything in common? Can we see some synergy? Is this a conversation that we think is worth continuing? And you can have that
hmm
meeting really before you make any big financial disclosures, because that's about people and understanding and market and strategy and opinion and all that, networks and all that kind of stuff. Like most relationships, you get a very good opinion in the first meeting whether you think it's going to work or not. Then after a chemistry meeting, I would then ask for a proper financial disclosure. Like if I think it's worth continuing, I'd ask them to put together a Dropbox or a data room of some kind. So
hmm
a data room is literally just a Dropbox or a folder on the web that everybody can access. And in there, you'd put detailed financial results, probably anonymized lists of your people so you can see how teams are structured, probably anonymized client lists at this stage, even though you're under NDA. But if you're
hmm
selling to anyone who's vaguely competitive, you probably still want to have that anonymous. So at that stage,
hmm
what I'm trying to work out is what's the shape of the business? How do the numbers work? How many people does it take to generate this revenue? How profitable is that business? How are the overheads structured? Is this a business that is in control of the money it's spending? So those are the questions you're trying to answer. And then, so I'd normally look back for 3 years of numbers. From those numbers, I'd do a valuation. And the valuation is always based on the same premise. Doesn't matter how you value businesses. There are lots of different ways of valuing them. You can do a revenue multiple. You can do an EBITDA multiple, so earnings before interest, taxation, deductions, and amortization. You can do discounted cash flows. There are loads of different valuation methods, but they're all based on the same premise. And I think people
hmm
misunderstand this a lot. When you sell an agency, no one is paying you for the years you have already put in. So if you
hmm
think you've put 15 years in and this is your payday and that's what you're being paid for, you're wrong. You're being
hmm
paid for the cash flows that company acquiring you is going to get in the future. So your
Right.
job is to convince them that this is an agency or a business that can produce long into the future for them, because that's what they're buying. So the multiple of EBITDA, for example, is based on the multiple you get is based on their confidence of your cash flow in the future. It's a really
Right.
important distinction to make that. And EBITDA is a useful proxy for cash flow in that instance, which is why it's often used as the multiple. So the valuation is going to be an indication of how confident your acquirer is on your ability to produce in future. And that will be a factor of how well you have sold your business. So what quality is your revenue? How good are you at growth? What does your sales engine look like? How good is your operational engine? Do you understand where your profit comes from. How tightly do you control your expenditure? What's your culture like? How good are your people? All these things.
Hmm.
Those will all be factored into what comes down to quite a simple valuation. So then once you've got a valuation, what I would seek to do is, so the valuation method that we use predominantly would be a multiple of EBITDA. So
Hmm.
I would then first seek to agree what we're going to use as our reference EBITDA. It can be a 3-year average, a 2-year average. It can be a weighted average over a period of time. It depends on the structure of the deal. Many different ways of agreeing that number. And then I would apply a multiple to that. And then if we can agree the number, I would then produce what's called a heads of terms. And the heads of terms is a document. It's not a legal document in its own right, but it's a briefing document that once it's signed has some legal implications, i.e., once you sign the heads of terms, you generally go exclusive with the person you're talking to.
Okay.
And if you pull out for no good reason, you're often on the hook for some fees, because as soon as it's signed, professional advisors get involved.
Okay.
But lawyers will then take that heads of terms, and then they will use the terms in that to draft the share purchase agreement, which is typically the document that you will use to paper the transaction. You then go to due diligence, and that's going to last
Hmm.
somewhere between 3 and 4 months. Now, I'm assuming we're talking about small businesses, so they're not going to come with their own due diligence ready-made. Bigger businesses would do that. So we get financial, legal, people, all sorts of due diligence. And then somewhere between 3 and 6 months after signing the heads of terms, you can expect to complete the deal. And then once you complete the deal, you get a bunch of money or shares, depending on how you structure the contract. And then that's done.
Okay.
So that's typically how the process works. And I think the shortest we did was about 3 months, and the longest was about 7.
Okay. We will go into what it looks like post
Yeah.
acquisition, but I wanted to come back to something. I don't know if I missed it, but you said you apply a multiple. What is that multiple and what is that based on?
Well, it depends. So the multiple is a representative of the quality we see in that business.
Okay.
And there'll be typical industry range. I'm a little bit out of date now. I would think a small business, so 500 to 800 EBITDA, is probably at the moment in the 3.5 to 5.5 range, maybe. A
Got it.
million plus, you might be in the kind of 6 to 7 or 8, but it's a tough market right now. What's important to understand is while there are sort of industry norms, the
Hmm.
most important thing is, what is the business worth to the company acquiring you? And so the price that they offer you is going to be a reflection of how much value they think they can create for themselves, probably over a 3 to 5 year period.
Got it.
So if someone comes back and offers you a multiple you think is derisory, doesn't
Hmm.
mean they don't think your business is good necessarily. If they did, they probably wouldn't offer in the first place. It probably means either they can't see how they can get value out of you to justify a higher value, or you haven't sold that value very well.
Thanks for helping me understand that a bit better. Hey, all, just taking a quick break to ask whether you've heard of Operations Nation. It's the global community for ops leaders of all stripes. They've got a buzzing Slack space. I know that because I'm a member myself, a COO course, and an annual conference that's coming up on the 20th and 21st of October in London. Go to operationsnation.com to learn more and use code SCORO for £30 off conference tickets. Now, back to the episode. So I think you were saying that you acquired 11 businesses in about 2.5, 3 years.
Yeah.
So let's talk about that post-acquisition process. What does that look like?
It depends business to business. So different people acquire in different ways. So if you take like a typical private equity platform, so a private equity house invests in typically an established agency that's been around for 10 or 15 years. They've got
Yeah.
2.5, 3 million EBITDA. Their revenues are north of 10 million. That's the platform. So when you get acquired into them, you're generally subsumed into them. You lose your brand. You adopt all of their systems. You adopt all of their operating procedures. You become
Hmm.
part of their outfit. That's typical. In our case, we were not seeking to do that. So when I sold my company, as I mentioned earlier, very early into the transaction, they changed a bunch of stuff that didn't really need changing. Like the business wasn't broken. They changed the board, they changed the operating procedures, they changed the product mix that we had, and it just didn't make any sense. So when we got into this business, knowing how risky M&A is, and it's really risky, it's a very easy thing to get wrong, we took a view that we didn't want to change much in the businesses when we bought them, because actually the transaction itself is really disruptive. And so we needed to give them the best chance of getting into that new environment as quickly as possible.
Right.
Now that, I think we took too relaxed a view on that, actually, in retrospect. In fact, I know we did. So there are some things that you would want to change and some things you wouldn't want to change. So I wouldn't want to change the name above the door. I wouldn't want to change, unless we pre-agreed it, I wouldn't want to change any of the key people, but I would potentially want to change the systems that they're using to do the day-to-day operations. Because especially if you're acquiring a lot, you don't want to end up with systems all over the place. It's quite tricky. Now, I think we had the view then that as long as we could API into the systems that they were using, and we could get the data out, then we'd be fine. The reality is you need people to operate systems day to day, and people don't work like APIs. They don't take data. They like to understand, you click on this and it does that. And particularly if you're thinking about kind of some of the operational backup and the accounting work that needs to be done, it's hard to operate 4 or 5 different systems at the same time. So, especially if you're centralizing any resources. So I think in retrospect, it's important to set expectations pre-acquisition of what's going to happen immediately post.
Right.
And I think one of the complications here is how you structure your deal. So typically, if one company is buying another company, unless they're very cash rich or they're doing a share swap, there'll be a bunch of cash that's paid at close, and then there'll be a period of time that is an earn-out that will be performance related. So in our case, for example, we typically paid 50% at close and deferred the rest over 3 years based on performance. But if you're buying a company and then saying it's up to you how much you earn, depending on how you perform, it's really hard then to go and say, oh, but by the way, you have to change this and that. Because they're going to go, well, hang on a sec, you're telling me that I've got to maximize my earnings. I like the systems that I have, which is why I have them. And therefore, why would I change them?
Right.
And so you need to think very carefully about that. Both if you're being acquired or if you're acquiring, be careful that the remuneration systems you put in place don't have unintended consequences in your operational systems, because often they do. So it's just something to think about. Now, I think in our case, we probably could have, had we been more transparent, and actually, frankly, had we had more of an idea of what we wanted the optimal system to be, to say, right, this is how we operate. When you join, these are the club rules. This is what you must do. We didn't do that. And look, we've got to buy. It's just, otherwise you end up having inefficiencies and you're just deferring difficult conversations.
That is really interesting, because you do want efficient reporting, like you were saying, and relying on APIs when everyone in the group is using something different is, I can imagine, quite painful and inefficient. I guess my question is this balance between change and then the implications of that versus not. I'm a bit confused about what the right answer is now. So
honestly, Harv, I'm not sure there is a right answer, and that's the problem. Okay. I think that's the problem. So I think a lot's going to depend on the culture of the company that is joining the new company. Like if you're very tech savvy, if the company's culture is very tech savvy and they can pick up and adopt a new system, like if you think about most systems these days, they're built to be intuitive. And although there'll be some training, there'll be self-service portals and all sorts of other things. Now, if your culture is that you don't like technology and you're still in business, you're lucky. But if your culture is that you don't like technology and you have to be trained to do everything, you're going to find changing your ERP or your agency management system really hard. And if you don't have a system and you're having to adopt one, and you don't understand that when you adopt technology, it's a two-way process. Like you take the technology as far towards the human process as you can, then you change the human process to meet the technology. If you don't do that when you're trying to integrate, and I've been there with one of our agencies, you get 18 months down the line trying to adopt technology and it just fails because you can never replicate exactly what the human systems were. And by the way, the human systems, they're not perfect or even ideal. They are what they are. So I think a lot depends on the mindset and the culture of the company being adopted. Now, in an ideal world, in an ideal world, everyone works on the same systems from day one. And I guess if you were going to be really smart about it, like you pretty much know 3 to 4 weeks before a transaction happens that it's going to work because you've ironed out all the
Right.
problems. And it, again, that depends. It's a cultural thing because quite often founders don't tell their teams until the transaction is absolutely done because they're
Mm,
worried that something might fall over. And if it does, they don't want to send up false signals or say, hey, we're for sale, and everyone leaves. But if you do have that kind of open culture, and we did acquire a few where it was very open and everyone knew it was happening, then you
mhm.
could, I suppose, start some training beforehand. So on the swap over day, everyone just comes to work and they have a new system. But the things that mustn't change are the quality of service to the customer, the feelings of security, potential, and growth for the people, and the culture of the company itself that gets acquired. Because if that changes too quickly, the people
Yep.
leave, and if the people leave, the clients leave, and then you lose the business.
hmm hmm One of my questions is we've talked about systems, but how much would you get involved in the operational side of things beyond that? So hiring practices and just kind of methodologies and things like that, or is that kind of this is meant to be working and that's why we're acquiring you, so we're not going to
Again,
tamper with it?
my instinct is to the latter, right? Why would you buy something if it isn't working? And it depends. Like everyone's obsessed about synergies when it comes to M&As. Because that's what the private equity guys look for. And they matter, of course. There has to be a rationale, right? But the rationale is often not just about synergy. It could be about capability, or there are loads of reasons to buy another company. Loads of them, and not all of them are about can we squeeze 1.2 out of one. So in an ideal world, everybody operates in a similar way, but there's a big tussle there between those are people who like to centralize and those who want
Yeah.
to decentralize. Now, I've always been a decentralizer. I believe decisions are best made closest to the customer, but there are some things that make sense to centralize. So your back office functions, particularly if you're doing lots of this stuff, finance, human resources, the IT management, that kind of stuff, makes sense to
hmm
centralize. There are other things that are agency specific that you don't necessarily need to centralize. So we tried early on centralizing our CRM. It didn't work. We
Okay.
spent a lot of money on it. That didn't work. So now we operate in an environment where the agencies get a lot of choice over what they do. They broadly operate to a similar cadence. So we do monthly management accounts, and everyone has the same sort of KPI structures and all that kind of stuff. But how they get to their numbers is kind of up to them. But I think it depends on how you're defining the culture of the vehicle you're trying to build. So, as I said, I was very decentralized. I would probably, were I doing this again, I'd probably come a little bit more back from being totally decentralized.
Right.
It makes sense to have a common technology backbone,
hmm
particularly these days. So that when we started in 2017, we knew AI was coming. It was in our original business plan, but we didn't necessarily understand the implications of LLMs. We were thinking more about algorithmic enhancement and mass personalization and that kind of stuff. The
Yeah.
LLM thing we didn't see. And with the capability now of LLMs to help you analyze data and provide that agentic layer on top of all of your data, it kind of makes sense. It really kind of makes sense to have a common backbone.
This question maybe is kind of not the smartest one. My question was going to be around how quickly do you expect reporting to be consistent in the format you require and that kind of thing. I guess you would expect that from day
Yeah,
one,
pretty
you
much.
know? Yeah.
Yeah, pretty much. Although yeah, you say that. But we're having a tussle at the moment with one of our agencies who still wants to keep reporting as they did 4 years ago when we bought them.
Okay.
So what happens is they produce an original format, and our accountants then change it into our format. It just makes
Right.
unnecessary work.
Yeah.
So it's not a dumb question at all. I would
hmm
expect it from day one, and we use absolutely standard best practice. But it's weird and wonderful how other people do their management reporting
hmm
and what they measure. So
Right.
you know,
Loads of questions coming up for me. So I'm kind of getting derailed from my discussion guide, but there's also like the accidental founder thing.
yep.
And you were mentioning that part of what you look for is strong leadership and this kind of understanding of operations and finance. Do you find that you need to do an education exercise on financials and kind of standardizing that? Or,
Let me talk broadly about the sector and the type of agencies rather than my particular experience, because that might be too personal. Look, I think there are a lot of people who don't get into this business because they're strong in finance. And I think that's a weak spot. So they're strong creatively, they're strong strategically, but they don't do numbers. I think it's really hard to run a business if you don't do numbers. And I think
Mhm.
I learned that, look, that was me in the year 2000. There's a book called Accounting for Non-Accountants, and I read it. And then you start practicing it and you get good at it. It's like everything else. If you make the effort and you learn, you get good at something. And I'm now reasonably good at numbers or accounting. But it staggers me how many people in our sector go, oh, I'm no good at numbers, and just think it's okay to say that. It's a bit like an Uber driver coming to work saying, oh, I'm no good at cars. If you're running a business, it is ultimately numbers. It is about making sure that you're making the right financial decisions to keep the people who are turning up every day and running your business for you, to keep them safe. And if you don't
Right.
understand numbers, so yeah, I was about to go off on one, but I won't. Yes, I think it's a problem in the sector generally, but if I came across somebody who really didn't do numbers, that's another massive red flag. I wouldn't buy them.
Okay. Okay. Yeah. One of our recent guests, Marcel Peripa, was talking about how you get to even a certain point or a threshold within the business itself where you just need to make sure that everyone is speaking the same language and has a common understanding of all this terminology
Yeah,
and stuff like that. So I suppose that that's all important.
I think that's important. I think there's another view, though, which I've come across where the leadership assume that other people in the business aren't interested in the numbers. So why would they want to know? They're a designer, or they're a this, or they're a that. But you should always share the numbers anyway, right? If they want to ignore them, let them, but give them the choice.
Yeah.
I'm a big fan of being transparent, because if you really want to take an agency and make it grow, it's not going to grow because of the founder. It's going to grow because the whole team is coalesced behind it and they understand the importance of the systems and the processes and everything else. So sharing those numbers is part of that process of actually becoming a mature business.
Absolutely. And I think the risk is probably that if you think your designers don't need to know, they're doing their thing, but they're missing the point of how to make money or what they're in it for and why you can't be over servicing. So in fact, it would do you well
So,
in order
so
to.
here's the funny thing. There's an assumption, oh, designers don't mind, because for them it's about the creativity. But show me an artist, who isn't aware of the value of the painting once he or she has completed it. They know their numbers inside out because that's how they eat. So creatives also can care about numbers.
Absolutely. All right, so let's talk about kind of culture. You were talking about kind of not wanting to spook the team that's being acquired and having everyone leave and stuff like that. But when it comes with when you acquire a business, there's merged units, change governance, culture change, stuff like that. My question is, how does that impact morale, and how do you make changes without kind of destabilizing everything? And
Yeah.
what you were saying earlier, without losing what made the agency successful in the first place.
So I think there are two or three things that you can do here if you're going out to acquire another business. Number one is think ahead. So put some content on about how you behave in acquisitions on your website. Make it very clear how you think. So we started a podcast where we talked about acquisitions and the process that anyone who knew they were coming to us could listen to, and that way they'd hear us in our own voice talk about what it meant. And we wrote blogs, and we were on LinkedIn being very vocal about the kind of people that we were and the kind of process that we operated. So the first thing is you can get ahead of it by producing content and letting people find it themselves. Secondly, you probably want to have a conversation with the company that you're acquiring to find out about their culture and how and when they want to talk to their people. The seniors probably want to be let in advance so that you can have a proper communication plan and so it can be cascaded properly. And then the third piece is, once you've done the transaction, I think, is getting in front of the new team as quickly as possible. So we would always pretty much on transaction day appear at the agency. It would be announced the transaction had happened, and we would tell them a little bit about the company that they had now joined, and then we'd have a warts and all any questions you want to ask. And in all instances, apart from one, that worked really well. In one of them, the very first one we did, I said, right, so any questions you want to ask, far away. And some guy turned around and said, "What makes you think you've got the right to fire me?"
Okay.
I'm really sorry. I'm really sorry. It was like,
Yeah.
okay, firstly, we don't. That's not how we operate. But yeah, that was a bit hostile. But most of them went really well. And actually, people appreciate that kind of transparency and openness. So I think, yeah, you can create some assets that people can find themselves. They're going to trust their own leadership more than they trust you. So make sure they're well briefed, and then make yourself available as soon as possible after the transaction and be as open as you can.
Really good advice. Dom, like, what's the biggest lesson that you'd say you've learned from buying and integrating over the years?
Set the house rules early.
Okay.
I think actually I'm going to go more basic than that. I'm going to go much more basic than that. My head is telling me that the most important thing is to set the house rules early. But there's something more visceral than that, which comes from your heart. Trust your gut. There's a couple of transactions that didn't go well, that I had nagging doubts about, that I thought were paranoia or insecurity or something.
Okay.
Now, they didn't necessarily fail, but they didn't go to plan. And exactly what I was worried about came to pass. So I would think, trust your gut. When you meet people, and when you meet the leaders of those agencies, your first instincts are probably correct. So don't ignore them.
Really good advice. We're coming towards the end. I've got a couple more questions. The first is, for businesses that are wanting to sell, what would you say they should be focusing on now to be more sales ready? Does anything from your point of view jump out?
Yeah, quality of revenue. It's
Okay.
all about, at the moment in this market, I think it's all about revenue. Well, obviously you need to be making a profit, right? Because the profit is going to be how you get valued. So in terms of the mechanics of your business, I think focus on your revenue and your quality of revenue. Get as much, because that's people like me, when they come along, will want to know how watertight that revenue is. That's what we look at. How much revenue can I see for the next 3 years? But there's something, again, more basic than that. I've got a head and heart thing going on at the moment. So the head is saying revenue. The heart now is saying, be very clear about why you want to sell and what you want out of the deal. Because it's quite easy to get lost when you get into that whole transaction. It's flattering when someone wants to give you loads of money to buy your company. Be very clear what it is you want and why you're selling your company, I think.
Excellent. My next question, Dom, is going back to what you said at the beginning. There was something about you saying that you've gone through a process that was very badly handled.
Yeah.
So could you summarize that for us then? What was so badly handled where you kind of developed your own process?
Yeah,
and said, never again.
Well, the business buying us didn't really want our business. They just wanted the revenues from it.
Oh, interesting.
So that should have been a red flag. I ignored my gut. The night before the deal, I didn't sleep at all because I was really doubtful about the person buying us. I just didn't trust her, and I was right not to. Within the first month and a half, quite a lot in the business was changed that didn't need to be changed, which didn't really make any sense. The business received no attention or love from the company that bought us. The cash was taken out to fund other things. The cash went out to fund other things. I don't want to imply anyone took it. The cash went out and it didn't get put back. And so what happened was, I was then told by the people who bought us, well, this business isn't viable. Well, no shit, Sherlock. All the cash has gone out of it. So you're going to need to put it into administration and we're going to rescind the deal. And so I think, number one, there was no strategic fit. There was no good reason why they wanted to buy us other than the revenue. They needed a story to tell their own investors. Bad idea to do that deal. Two, my gut told me not to trust the person who was running the deal. And my lawyer told me not to do the deal, but I ignored both my gut and my lawyer. I had other people pressurizing me to do stuff. And then number three, the behavior of the senior team that bought us post-transaction was terrible. It was just really bad. Yeah. So I ended up, I had to sell a house to get myself out of that deal. So it was bad. So coming to this one, there were things like, number one is, unless there's a good reason or we tell you, the name's going to stay above the door. Right? We're buying you because you work, and therefore we're not going to mess around with you. But we would like you to do the following things in time. Move onto a common platform. Except there'll be some centralized services. Except we're moving into a growth culture. So there were some rules, but above all, it was to always to treat people like adults, never infantilize, never bully them, and we've lived up and been true to that.
Great. Dom, so we've been talking very much about the business being acquired and that kind of experience, but you were talking about raising funds. Where does that come from? If somebody does want to acquire another business, is it kind of your own
Well, it
pockets,
depends
or
on, yeah, so quite a lot of people build cash in their businesses over time because in case they sell, I suppose they can take it out tax efficiently, or they want to buy. So one, you might be able to develop or grow your own funds. Two, you can use debt to buy. Quite a lot of companies use debt. There are
okay,
venture credit companies out there. Typically, you need £500,000 or more in EBITDA to be able to support that. But there are levels of debt that you can get to do that. You could look at, I mean, debt is obviously risky. You could take external investment, that's hard to find. Or you could do a deal whereby you are doing some kind of a paper swap. So it's some cash, some shares. Typically, though, because a trade sale will typically be levered. So if you're buying a business for £2 million or £1 million, let's say,
hmm
your closing requirement on day one will be £500,000 if you're paying 50% down. So
right,
actually, if you break the chunk down of what you want to buy and you look at how much cash you need to get there, then often you can find creative ways to get the money.
got
The
it.
best way to do it, of
Okay,
course, is to earn the
yeah.
money first and then spend it.
hmm You talked about earlier that the market's worlds apart from when you
Yeah.
first started up. So obviously some things come to mind for me, but what is worlds apart? What's
So,
changed?
well, in 2017, 2018, we'd come out of the 2008, 2009 slump. And since something like 11 or 12, it had been 6, 7 years straight line growth. Everything was
hmm
growing. So anyone who started and sold an agency in that period knows how to sell something when the tide is rising.
hmm
And then in 2020, we had COVID, obviously, and we had lockdowns, which is very disruptive. So not many people didn't lose at least a part of their business. We lost some sizable pieces.
hmm
Travel and tourism and all that side of business just went. So we had a little bit of that kind of business. Then we have in 2022 war and inflation and interest rates and budgets and all sorts of stuff. And now we've got like the most extraordinary. I think I listened to an internal presentation that I've made actually last night. The pestle analysis, political, economic, social, technological, etc., etc. All of them are off the charts. Like the
mm
political system around the world is mad.
mm
Like we're in the middle of whether we're technically in a recession or not, I don't know, but we're in the middle of a horrible recession. There's
mm.
social unrest wherever you look at it. AI is completely changing the world. Like all of the things that we used to take for normal are now mad. Everything's mad. So we're
Yeah,
living in this extraordinarily volatile world where you can't guarantee that what you had last month is what you're going to get next month. We
right,
just don't know.
right.
And that's what I'm talking about. That's why it's so hard now to do the things that we could do with ease in 2017, 2018.
hmm Is the agency space a good business to be in? Looking at
It
what
depends who
we're
you are. It
in.
depends who you are, I think, doesn't it? I think it's really tough at the moment. I think agency is really tough. In housing, offshoring, and AI are all denting. Like the business is changing. It's fundamentally changing.
hmm
But I think it needed to. I think the whole digital marketing stuff that started appearing post millennium has led a lot of agencies into doing production, performance, that kind of stuff. And there's probably a
hmm
cheaper or better way of doing it these days. So we know part of it's evolution, part of it's revolution. I think if you get it right, if you're very tech enabled and you're very data led and you're good in your AI, it's a great space
hmm
to be in. If you're not, I would look elsewhere.
You're in trouble.
Yeah.
And how do you see the next few years in the agency
Well,
space? Things like,
I'm a bear.
tr-
I'm afraid I'm a bear. I see it being
mm,
exactly the same as it has for the last 2 or 3 years.
okay,
Our government's not going anywhere. The American government's not going anywhere. There's no sign of peace in the Middle East or Ukraine. Interest rates, I suppose, are stabilizing. But where's the confidence going to come from? And even if it does come from anywhere, pretty much most of the Western world is bankrupt at the moment. I don't want to be too depressing. But there's
hmm
no indication. We might see some economic growth, but there's not much indication that big confidence is going to recover. So where I am at the moment, everything's got to be stripped bare. We've got to get into survival mode because I don't see an improvement in the next
mm,
2 to 3 years necessarily. Now, that doesn't mean there's not opportunity. There's always opportunity. And
yeah,
well-run agencies are doing extraordinarily well. I saw there were 5 in the Times top 100 this week, 5
mm,
marketing
hmm
slash sales agencies. We've got agencies in our group who are knocking it out of the park, but they've all got good discipline. It's all about that.
Right.
Yeah.
Yeah. And that's kind of been my view recently, is that more than ever, focus on profitability and efficiency
Totally.
and all that kind of
Yeah.
stuff is critical. You can't just wing
Got
it
to be
anymore,
commercial.
right?
Got to be overtly commercial, because no one's going to hire you because you make pretty pictures. They're going to hire you because you're going to help them make more money. That's why they hire you.
Absolutely. Absolutely. Dom, this has been super enlightening. So thank you
No,
so
it's been
much.
fun.
If
Thanks,
anybody
Al.
wants to reach out to you and get any advice and things like that, where can they reach you?
Well, they can find me on LinkedIn,
Okay.
Dom Hawes. So they can find me there. That's probably the easiest place. Yeah.
Excellent. So that was Dom's take on scaling through M&A. And as someone focused on operations, there were a few points that really stood out to me. First, Dom put it bluntly. If you're in a leadership role at a service business and say, I'm not a numbers person, that's a problem. Your team relies on you to make sound decisions. And without a grip on your numbers, that's almost impossible. He also made it clear that strong operations make a business more attractive. The goal isn't to acquire a company and start meddling or clean up their mess. It's to bring in businesses that already have a strong handle on how they run and maybe make some tweaks to consolidate with the group. Speaking of consolidation, I also noted Dom's reflection that not standardizing systems early on was a mistake. When every business in the group is using different tools, it becomes harder to centralize reporting, coordinate on finance, and run efficiently. So that was good advice. In many ways, a lot of this connects back to what Sam Wood said in the last interview. A clear strategy, strong governance, visibility, and accountability are what make your business scalable and sale ready. So whether you're on the buy side or the sell side of a future deal, the operational foundations matter. The quality of your revenue, the maturity of your systems, the consistency of your reporting, it all plays a role in how attractive your business is and how well it integrates into something bigger. All right? If you'd like a copy of the key learnings from this episode in your inbox, then sign up for the Handbook newsletter. The link is in the episode notes. The newsletter always goes out the week after the episode. And lots of more great content coming your way, guys. Help us grow the audience. Please rate the podcast on Apple or Spotify and share the podcast with your networks. I really, really appreciate it. That's it for me this week. Thanks so much for joining us. This podcast is brought to you by Scoro, a platform designed for agencies and consultancies, which allows you to manage your projects, finances, and resources, all from one system. This is a platform I brought in at a previous workplace, which completely transformed the way we worked, and which I've recommended to clients of my own. You can sign up for a free trial on Scoro.com. That's SCORO.com. Or reach out to me, Harv Nagra, on LinkedIn if you'd like to hear about some of my experiences.